decision less than 24 hours away now. The market's not waiting around to find out what happens either. The question is today's sell-off a precursor to an even bigger move tomorrow, or will the Fed chair soothe investors just when they need it the most? Let's ask Virtus Investment Partners Chief Market Strategist Joe Terranova joins me right here on set. It's good to see you.
Good to see you.
Less than 24 hours away. What are you expecting? What do you think the market's going to do tomorrow?
Well, I think investors want comfort, and I think the press conference is the venue that ultimately Chairman Powell can deliver the comfort. He can deliver the comfort by letting investors in a very subtle way know that hawkishness is transitory. If he does that, then I think the way that the market right now is currently positioned, both from the standpoint of sentiment and actual positioning in the market, I don't think the market's ready for that. I think at that point, markets can rally. If he stays away from that, if he doesn't indicate that the hawkishness is transitory, then we know you've got to turn your attention to the Treasury market. You have to focus on short-term yields. Yeah. And I think ultimately, Scott, what you're looking for is some parabolic move that will signal a peak and capitulation. Capitulation is going to come in the market. It's coming in the Treasury market. I don't think it comes in the equity market.
Let's stay away from the transitory word, could we?
Sure.
Right, because, I mean, the market doesn't want to hear that word anymore from the Fed chair for obvious reasons.
Because it hasn't worked.
What you're alluding to, though, is a peak hawkishness, leaving the market with the belief that this is about as hawkish as they're going to get. Give you 75, and then sort of let's take a look at the data. Let's see where we are. We're not thinking 75 and then huge hikes to follow that going forward, right?
So the disposition of the last several months, the current disposition, unprecedented. The Federal Reserve will move away from that unprecedented hawkishness disposition. That's the right way, I think, to frame it.
All right. So the bond market seems ready for a hawkish Fed chair,
sure does.
Right? We're just at 2-year, which everybody says the Fed follows the 2-year.
Right, and everyone wants to put their money into it.
Right at 4%. Right? Is the stock market ready for a hawkish Fed chair?
You know what's interesting is just looking, first of all, and I've said this ad nauseum throughout the quarter, I believe that quants and the algos are in control of the market. I think the good thing that's happened here is that this is a U-shaped correction, the first one since the great financial crisis. Why is that good? Because that has given retail and wealth management the time to extract the concentration. So right now, Scott, portfolios, there's not that portfolio imbalance that needs to be rooted out. Portfolios are very diversified right now, and cash balances are very high, historically high. You've got to really present something very bearish, introduce something new, geopolitical, or something from the Federal Reserve that's going to flush the market very quickly down, because I just don't see sentiment and positioning aligned accordingly.
Okay, you say the word flush. Dr. Doom, is that Nouriel Roubini? They call him Dr. Doom, right?
I remember him.
I think they coined that for him. He sees a quote, long and ugly recession in the U.S. He gave an interview to an outlet today in which he said, even in a plain vanilla recession, the S&P can fall by 30%. In a real hard landing, quote unquote, which he expects, by the way, it could fall 40%. Is this just another doomsayer trying to make a big downside call? I'm not suggesting that, Scott Minerd is necessarily a doomsayer, but he's looking for 20%. Gundlach wouldn't argue with that. Dalio said a move to 4.5% in rates would cause a 20% decline. This is becoming in vogue now.
Listen, I've learned a long time ago in the market, you respect everyone's opinion. You're not dismissive of anything. I think what's very important is that in the case of Scott Minerd, he talked about 20% down and said, I will be a buyer at that level. And I think a lot of people have maintained that thought process. I as well. If the market takes out the June lows, for all of you that 1 year ago said, hey, we don't want to be buyers of this market because the valuation is too rich, here's your opportunity. If you don't have a need for cash in the next 2 years, here's your chance. If you have a need for cash, okay, go to the Treasury market, buy short-term notes.
Do you think stocks are expensive or not right here, right now? Because Lee Cooperman was on Squawk this morning and suggested stocks, even though they're down 20% year-to-date, S&P, roughly, right? Mm-hmm. Not cheap. Stocks are not cheap. Now, there may be selective stocks within the universe that are cheap, and he would even tell you that, in which he said the same thing. But broadly, 20% decline. Are stocks cheap or not?
So generally what happens in a recession is there's three shapes of a recovery, L, U, and V. I think that a valuation recession began in early 2021. If you look at the Russell 1000 Hyper Growth Index, you'll see the PE peak in early 2021 up near 30. That's now fallen below 20. That's an indication to me, first of all, that's where the L-shaped recovery is ultimately going to unfold. But I think you've had this valuation recession and you've had capitulation that's kind of rolling throughout sectors and strategies within the market. So I don't know that the entirety of the market can be defined as being expensive. I'm not sure that I agree with that. And I do think you could find opportunities within the market where reasonable valuations present themselves.